Let me ask you a question that might change your perspective. What if the most significant financial repositioning of the decade is happening right now in plain sight, while financial media obsesses over interest rates and inflation headlines? China's dumping U.S. Treasuries, while simultaneously stockpiling silver at rates that would make industrial users panic. But here's what nobody's explaining. The mechanism behind this trade isn't just economic strategy. It's surgical financial warfare disguised as portfolio rebalancing. I've spent 2 decades watching central banks play their games, and this one's different. This isn't your typical de-dollarization narrative where we all nod knowingly about reserve currency shifts. This is about leverage, optionality, and creating monetary pressure points that most analysts completely miss because they're looking at the wrong metrics. The numbers tell a story that should terrify anyone holding long-dated bonds. Since early 2022, China has reduced its U.S. Treasury holdings by over $200 billion. That's not a trim. That's a strategic exit from a position they once considered untouchable. Meanwhile, their silver reserves, both official and through state-affiliated entities, have expanded at rates that exceed their industrial consumption by margins that make zero sense unless you understand what they're actually building. But we're getting ahead of ourselves. Let's start with the mechanism itself, because understanding how this trade works reveals why it's so much more dangerous than conventional wisdom suggests. When China sells U.S. debt, they're not just clicking a button and walking away. The process involves a calculated sequence that maximizes their position while minimizing market disruption, at least disruption that would hurt them. They're using a combination of direct sales to private buyers, allowing bonds to mature without replacement, and strategically timing their exits during periods of high liquidity when the Federal Reserve's balance sheet operations can absorb the flow without spiking yields too dramatically. Consider this for a moment. Every dollar of Treasury debt they shed needs to convert into something else. This is where the mainstream narrative falls apart. Financial media assumes they're rotating into euros or yen or even their own bonds. Some of that's happening, sure, but the silver accumulation tells a completely different story about their actual strategy. Silver isn't just another commodity in their basket. It's a strategic metal with unique properties that make it perfect for what China is attempting to construct. An alternative settlement system that bypasses dollar hegemony while maintaining tangible value that can't be sanctioned, frozen, or inflated away by Western central banks. The mechanism works like this. China sells treasuries, generating dollar liquidity. Those dollars don't sit idle. They move through a network of state banks, sovereign wealth vehicles, and affiliated trading companies. Some portion converts directly to yuan, supporting their currency during what would otherwise be downward pressure from capital outflows. But another portion, the portion that matters for this analysis, flows into physical commodities, with silver taking an outsized share relative to historical norms. Now here's where it gets interesting. Silver purchases don't show up in official reserve data the way gold does. Central banks report gold holdings to the IMF. Silver? It's classified under industrial stockpiles, strategic reserves, or simply doesn't get reported at all if it's held through commercial entities. This creates perfect opacity for accumulation without triggering the kind of market panic that massive gold purchases would generate. The People's Bank of China isn't stupid. They watched what happened when they started adding gold aggressively. Prices spiked. Competitors noticed. Western analysts started writing alarmed reports. But silver? Silver's been in a bear market narrative for so long that massive accumulation flies under the radar. Industrial demand story, green energy story, solar panel narrative, all convenient cover for what's actually happening. I want you to understand the scale we're discussing here. Global silver production runs about 800 million ounces annually. Industrial demand consumes roughly 600 million ounces. Investment demand, coins, bars, ETFs, takes maybe another 150 million. The market looks balanced, maybe slightly deficit, but those numbers hide the real flows because they don't capture off-market accumulation by state entities that aren't reporting their purchases. Now, let's connect the dots. If China's diverting even 5% of their treasury sale proceeds into silver, and evidence suggests it is higher, we're talking about $10 to $15 billion annually. At current prices, that's somewhere between 400 and 600 million ounces of buying pressure, in a market that produces 800 million ounces total. Do you see the mathematical impossibility of hiding that without massive price suppression? This is where the mechanism reveals its true sophistication. China isn't buying silver in New York. They're not stacking COMEX contracts and demanding delivery like some Reddit silver squeeze fantasy. They're buying production directly from mines, securing long-term supply contracts at fixed prices, and vacuuming up refinery output before it ever touches an exchange. They've inked deals with South American producers that lock in supply for 5, 10, 15 years. They've invested in African mining operations that give them first call on output. They've built refining capacity that processes imported concentrate into physical silver that never appears in trade statistics because it never crosses a border as finished product. The genius here is they're acquiring a strategic asset at artificially suppressed prices while simultaneously reducing exposure to an asset, U.S. Treasuries, that they know is overvalued given the fiscal trajectory of the United States. This makes all the difference between a simple portfolio rotation and a calculated positioning for monetary transition. Let's talk about why silver specifically, because this is the key insight that separates surface-level analysis from understanding their actual strategy. Gold is money. Everyone knows this. Central banks hold it. It's in the IMF's special drawing rights basket. It's recognized globally as a monetary metal. But gold has a problem. It's already been claimed by the existing monetary system. Western central banks hold roughly 33,000 tons. The United States claims 8,000 tons, though that hasn't been audited in decades. Gold is establishment money. Silver occupies a different space entirely. It has 5,000 years of monetary history. It's mentioned in the Bible as money. The word for silver and money is identical in dozens of languages. But in the modern era, it's been demonetized, classified as an industrial commodity, and systematically suppressed to maintain the illusion that paper currency doesn't need metallic backing. China recognizes that in any future monetary reset, whether that is a formal restructuring or an informal shift away from dollar dominance, silver provides unique optionality. It's cheap enough to accumulate in massive quantities. It's essential enough for industrial use that they need it anyway. And it's monetary enough that in a crisis, it becomes an alternative settlement medium that circumvents the dollar system entirely. But gold's expensive, and every ounce they ship out is an ounce they don't have for reserves. Silver, trading at a gold to silver ratio of 80 or 90 to 1, provides the same monetary function at a fraction of the cost. They can move larger volumes, settle bigger trades, and still maintain their core gold position intact. This is the mechanism in its second layer. Accumulate silver as a monetary buffer asset that provides settlement optionality without depleting primary reserves. It's brilliant because it exploits a market inefficiency created by decades of Western central bank propaganda that silver isn't money. The key insight here is that China doesn't need the world to agree silver is money. They just need their trading partners to accept it as settlement. And when you're the world's largest manufacturer, largest exporter, and largest trading partner for over 120 countries, you have substantial persuasive power. But there's a third component to this mechanism that most analysts completely miss: the paper-silver market and how China's physical accumulation creates a ticking time bomb under the entire derivative structure. The COMEX and LBMA trade paper silver claims that exceed physical inventory by ratios that would be criminal in any regulated securities market. Estimates vary, but conservative analysis suggests somewhere between 100 and 300 paper claims exist for every ounce of physical silver supposedly backing those contracts. This works fine as long as everyone plays along. As long as futures traders settle in cash, as long as ETF holders don't demand redemption, as long as industrial users can source supply from recycling and current production. The system maintains its illusion of liquidity and price discovery. But consider what happens when a major player, say a nation-state with effectively unlimited currency to deploy, begins systematically removing physical metal from the system, while the paper market continues expanding to meet investment and hedging demand. The gap between paper claims and physical reality widens. Every ounce China pulls into their vaults is an ounce that can't be used to settle a contract, deliver against an ETF share, or supply an industrial user who suddenly can't source material. The system becomes increasingly fragile, increasingly dependent on the assumption that physical delivery will never be demanded at scale. Now, think about the timing. China's dumping treasuries at an accelerating rate. The U.S. fiscal deficit is exploding. The Federal Reserve is trapped between inflation they can't control and a debt market they can't afford to let collapse. Something has to give. When it does, when there's a treasury market crisis, a dollar crisis, or broader monetary crisis, what do investors traditionally flee toward? Precious metals, gold spikes, and silver with its smaller market and massive paper overhang goes absolutely parabolic. China knows this. This is why the mechanism isn't just about accumulation. It's about creating the conditions for a market break that validates their positioning while devastating everyone caught on the wrong side. Here's what matters most. They don't need silver to go to $100 an ounce or $500 an ounce, though it might. What they need is for the paper-silver market to break, for physical to decouple from futures pricing, and for reality to reassert itself in a market that's been living on synthetic supply for decades. When that happens, their physical holdings become worth whatever price industrial users are willing to pay to keep factories running. Their strategic stockpile becomes a negotiating tool in trade relationships, and their exit from treasuries looks like the most prescient macro trade of the decade. Let me walk you through how this could unfold, because the mechanism has a logical endpoint that should concern anyone holding paper assets. Stage 1 is what we're seeing now: quiet accumulation while maintaining the appearance of normal market conditions. China sells treasuries gradually enough that the Fed and primary dealers can absorb the flow. They buy silver through channels that don't trigger obvious price spikes. The narrative remains boring. Chinese rebalancing, diversification, nothing to see here. Stage 2 begins when either market conditions force their hand or they decide they have accumulated sufficient physical position. This could be triggered by a Treasury market accident, a geopolitical event that freezes dollar settlements, or simply the realization that their debt holdings have become a liability rather than an asset. In Stage 2, they accelerate Treasury sales regardless of market impact. Yields spike. The Fed faces an impossible choice: let long-term rates rise and crash the economy, or intervene with unlimited QE and destroy the currency. Either way, the dollar's status as the unquestioned reserve currency takes damage. Simultaneously, global attention turns to alternatives. This is where silver enters the mainstream consciousness. If gold's already expensive and climbing, silver becomes the accessible alternative. Investment demand floods into a market that has no physical supply to meet it. The paper market begins showing stress. Stage 3 is the break. A major institution fails to deliver physical silver against contracts, or an ETF suspends redemptions, or industrial users start bidding absurd premiums over spot price to secure supply. The price discovery mechanism that relied on paper trading collapses, and physical metal starts trading at massive premiums to whatever number still prints on future screens. China, sitting on potentially billions of ounces accumulated at $15, $20, $25 an ounce, now holds an asset that's worth whatever the market will bear. More importantly, they hold physical settlement capability that bypasses the dollar system entirely. This isn't speculation. This is game theory played out to its logical conclusion based on observable actions and historical precedent. It's happened before with other commodities when paper markets diverged too far from physical reality. Oil in 2008, palladium in 2000, rhodium in 2021. Silver's market structure is even more fragile than those were. Now, I know what you're thinking. If this is so obvious, why isn't everyone talking about it? Why aren't Western central banks responding? Why do mainstream analysts dismiss this as conspiracy theory? The answer is simpler than you might imagine. Acknowledging the mechanism would require admitting that the emperor has no clothes. It would mean confessing that treasury markets depend on foreign buyers who are now exiting, that precious metal prices are suppressed to maintain currency legitimacy, that the entire dollar system rests on faith rather than fundamentals. The Federal Reserve can't admit this. The Treasury Department can't acknowledge it. Banks that are short hundreds of millions of ounces of paper silver certainly can't draw attention to the scam. So the strategy becomes ignore, dismiss, and pray that China doesn't push the system to its breaking point. Let me share a perspective that often gets overlooked. But here's the reality check. China does not care about the Fed's comfort level. They don't care if JP Morgan's commodity desk implodes. They care about positioning their economy, their currency, and their geopolitical influence for a post-dollar world. And every $1 billion of treasuries they convert to physical silver is another step toward that objective. The mechanism is elegant because it's self-reinforcing. So the more treasuries they sell, the more pressure on the dollar system. The more pressure on the dollar system, the more attractive hard assets become. The more attractive hard assets become, the more stress on paper markets that can't deliver physical. The more stress on paper markets, the faster the system approaches its breaking point. They've essentially created a financial mousetrap and baited it with decades of Western arrogance about dollar dominance and paper market stability. And here's the part that should really concern you. They're not alone. Russia's been doing a version of this since 2014, though with more emphasis on gold. Middle Eastern sovereigns are quietly diversifying away from pure treasury holdings. Even traditional U.S. allies are reducing dollar concentration in their reserves. China's mechanism is just the most sophisticated, the most aggressive, and the most directly targeted at exposing the weakness in the system. They're not trying to destroy the dollar out of spite. They're trying to create leverage, optionality, and insurance against a monetary system they don't control, and increasingly don't trust. Consider the geopolitical implications for a moment. If China successfully accumulates enough physical silver to corner the market, or even just to control a dominant position, they gain enormous influence over any industry that depends on the metal. Electronics, solar panels, medical equipment, defense systems, electrical infrastructure. Silver's industrial indispensability means whoever controls supply controls critical supply chains. In a world that's increasingly confrontational between the US and China, that's a weapon more potent than most people realize. But it's the monetary aspect that represents the real paradigm shift. If silver returns to its historical role as a settlement medium between nations, even just for trade outside the dollar system, the implications cascade through the entire global financial architecture. Suddenly, countries holding treasuries as reserves have an alternative. Suddenly, bilateral trade can settle in physical metal rather than dollars. Suddenly, the Fed's ability to export inflation through the reserve currency system diminishes because there's an escape valve. This is what the mechanism ultimately achieves. It creates the infrastructure for a parallel monetary system that operates independently of Western control. And it does so using an asset that Western central banks don't hold, don't control, and have actively suppressed for decades. The irony is delicious. By demonetizing silver, by pushing it into the commodity category, by allowing paper markets to obscure physical reality, Western monetary authorities created the perfect asset for rivals to exploit. They handed China the weapon being used against them. Now let's address the practical question. What does this mean for you, for markets, for the economic system you operate within? First, understand that this isn't a next week or next month phenomenon. China's playing a long game. They might be accumulating for another year, 3 years, 5 years. The mechanism doesn't require specific timing, just continued execution until conditions align. Second, recognize that the Treasury market and the precious metals market are more connected than conventional analysis admits. If you're watching for a Treasury crisis, you should simultaneously be watching silver's physical markets. Stress in one will likely coincide with stress in the other. Third, accept that paper prices might not reflect reality until the moment they suddenly do. Silver could trade sideways or even decline while physical accumulation continues. The gap between paper and physical can widen for far longer than seems rational, until it can't. The system's fragility doesn't announce itself with clear warnings. It maintains the appearance of stability right up until the discontinuity hits. This is how complex systems fail, not gradually, but suddenly, after absorbing stress that wasn't visible in the metrics everyone was watching. China understands this. They're applying stress to the system through treasury sales, through physical accumulation, through creating alternative settlement mechanisms, while the system insists everything's fine. The mechanism's working exactly as designed. For those paying attention, the message is clear. The monetary order that has existed since Bretton Woods is in its terminal phase, not because of ideology or theory, but because the mathematical realities can no longer be hidden. Debt levels are unsustainable, currency creation is out of control, and rival powers have found the exploit in the code. Silver's just the tool they're using. The real mechanism is the transfer of monetary power from west to east, from paper to physical, from assumption to reality. And it's happening right now, in plain sight, while most people remain convinced that the system they've known their entire lives will persist indefinitely. It won't. Systems never do when the fundamentals shift this dramatically. History is full of monetary transitions that seemed impossible right up until they became inevitable. The gold standard's collapse in 1971, the Soviet ruble's evaporation in 1991, the Weimar Marcus hyperinflation in 1923. All of them had defenders insisting the system was sound right up until it wasn't. This transition will be different in specifics, but identical in principle. The old order will resist until resistance becomes impossible, then everything will change very quickly. China's trading US debt for silver because they understand what's coming. They're positioning for the transition while everyone else is still pretending it won't happen. The mechanism they're using, systematic treasury reduction combined with strategic metal accumulation, is both the preparation and the catalyst. When the history of this period gets written, this trade will be analyzed as either one of the most brilliant strategic repositionings in financial history or one of the most obvious setups that everyone somehow missed. I know which way I'm betting. The question is whether you are seeing what's actually happening or what you're being told to see, because that distinction will determine whether you're positioned for what comes next or devastated by it. The mechanism's in motion. The pieces are moving. And the endgame is becoming clearer every quarter as China's treasury holdings shrink and their physical metal stockpiles grow. You can dismiss this as conspiracy, as fringe analysis, as alarmist speculation. That's your choice. But while you're deciding, China's central bank is executing their strategy with precision, patience, and a timeline that doesn't depend on your belief or understanding. They're not waiting for permission. They're not asking for consensus. They're simply doing what strategically rational actors do when they see an opportunity and a vulnerability. Exploit it until the system adjusts or breaks. The only question left is timing. And even that's becoming clearer as fiscal deficits expand, as treasury auctions show weaker demand, as physical metal premiums widen in Asian markets, as the gap between what's claimed and what exists becomes too large to hide. The mechanism's working. Watch the treasury data. Watch the silver flows.